Our next speaker is Andrew Shapiro. He's the founder and managing partner at Broadscale Group, LLC. He spent nearly 3 decades working at the nexus of new technologies and societal transformation, with a focus over the last 20 years on sustainable technology and innovation. And they've made a lot of big bets recently. So with that, we leave it to Andrew. Please take it away. Very great to see you.
Thank you, Rob, and thank you to Peter as well and the whole team for having me. It's great to be back at the Wall Street Green Summit. So as Rob said, I'm Andrew Shapiro. I run Broadscale Group. I've been in the sustainable innovation and investment space now for more than 2 decades. I started and ran a firm called Green Order that worked with more than 100 large enterprises on their sustainable business strategies, and then started Broadscale Group a decade ago. Our mission is disruption for good, by which we mean the transformation of traditional industries in ways that will be positive for the environment, society, and all stakeholders. And we pursue our mission through 2 different vehicles. We have a corporate network with which we are sourcing strategic investments and partnerships and driving collaboration between startups and incumbents to turn innovation into impact. And then we have a family office network with whom we've made 15 investments in energy transition companies, including some I'll talk about today. We also have a SPAC, and I'll talk a little bit about the SPAC market, Broadscale Acquisition Corp, which has announced its merger with a company called Voltus, which is a leading software platform in the distributed energy space. So let me talk a little bit about the challenge of scaling innovation for clean energy and sustainable business generally. We tend to think about 4 different important vectors: capital, technology, policy, and consumer demand, whether that's B2B or B2C. And I'm going to talk a little bit about each and where we are. Starting with technology, obviously to scale sustainable business solutions, we need a seamless process from invention to deployment to scaling. And you'll see this bridge behind me. We like to use this image because we think about the bridge to bankability and overcoming the chasm of commercialization that we all know has been such a challenge for new technologies in this area. And that's because we're dealing with industries like energy, transportation, the built environment, food and ag, which are harder to transform than coming up with a new social media app like TikTok or something like that. And so there is a real challenge there from a technology standpoint. But the key thing to focus on is that while there are asset intensive parts of the clean energy world, there are also new technology companies that are software driven and data driven, like Voltus, as I just mentioned, which we can talk about more. And then critically, there are important strategic partnerships that can be formed between startups and major incumbents that are going to drive change more quickly. To give one example of that, Proterra is a technology company in the commercial electric vehicle space. We like to think of them as sort of the Tesla of large vehicles. And they make electric transit buses, and they are the OEM for those buses and do the battery technology. But they also sell their battery technology to other OEMs. For example, Daimler, which was a strategic partner and investor in the company. And now Daimler is rolling out electric school buses under their Thomas brand. They're one of the largest school bus manufacturers, and they're using batteries from Proterra. So you have a strategic partnership there where you're taking a new technology from a growth company and putting it into the products of an incumbent. The other thing we're seeing more is that companies in this generation are getting smarter about product market fit, a key concept for entrepreneurial businesses. And I think of another portfolio company of ours, Via, which some of you who are New Yorkers may know. Via started originally to compete with companies like Uber and Lyft, providing shared rides around cities. But they quickly realized that given the competition from those businesses, they had a better product market fit to sell their software directly to cities and transit agencies to improve public transit through dynamic routing of public transit vehicles. And so that was an important pivot that that company undertook. And Via, like Proterra is now a public company, went through a de-SPAC last year, and Via announced at the end of last year its intent to go public soon. Finally, I'll also mention another company in our portfolio, Revel, which is an interesting example of expansion of a product portfolio from their initial focus, which was on shared electric mopeds. Again, New Yorkers will know that. You've seen their mopeds all around, to now becoming a company focused more broadly on electrifying all urban transit. So they've launched the first, or I say the largest, hub for high-speed EV charging in Brooklyn. And they've even launched a rideshare business. So you may have seen their blue all Tesla fleet of rideshare vehicles out there. So these are all examples of where technology is progressing because of smart strategies that companies have undertaken. Now let's talk about capital a little bit, because that's another critical area, whether it's everything from early grants, non-dilutive capital, to seed stage, series A, B, C, and beyond, to growth equity, debt, public markets. The good news is there's more capital than ever flowing into ESG, climate tech, sustainable investing, whatever we want to call it. And let me give you some statistics to show that. In 2021, $120 billion flowed into ESG funds, which was more than double the amount in 2020, which was $51 billion. By some measures, 1/3 of all investment portfolios now include sustainable assets, which is great, but we need that number to be higher. And then if you look specifically at climate tech, the numbers have been also really impressive. In 2021, about $40 billion was deployed in climate tech, and that's more than twice as much as was deployed the year before in 2020. And this capital is coming from a diversity of sources. Obviously, financial VCs, private equity, public market investors, but also importantly, corporate venture capitalists and strategic capital providers. For example, Shell, which is one of our network members at Broadscale, was the largest investor in clean energy by a number of deals last year. The other thing we're seeing is a huge influx of capital to some of the largest asset managers to deploy. So you probably read about funds like Brookfield, which has a $7 billion fund in this space, TPG, a $5 billion fund, BlackRock, General Atlantic, Apollo, and on and on. All the largest institutional investors are now active in this space. We also need innovations in capital provision and financing, and I'll mention two particularly. We're big fans of the idea that to get across this bridge of commercialization, you need to make clean technology solutions cost neutral from the start point compared to their alternatives. So the key to this is no money down financing. And the real place we saw this first as an innovation was in solar with the solar lease, pioneered by Solar City and Sunrun and others. And if you can go to a consumer and say, hey, you're buying power from a utility, but we can provide it for you more cheaply with a cleaner solution, people will adopt that, whether they're environmentalists or not, whether they care about climate. So we're very focused on where we can lower the first cost or take away the higher first cost altogether and provide everything as a service, so to speak, right? And we saw that in solar. We're now seeing it in electric vehicles. There's a couple of companies we've had speak to our groups. Spring Free EV is one, another is Inspiration, that are providing financing for electric vehicle fleets. We saw an announcement just this week that ChargePoint, the big EV charging company, is partnering with Goldman Sachs to make charging as a service competitive. We have an investment in Generate Capital, which is providing sustainable infrastructure finance to every type of different infrastructure technology you can imagine. And then even looking globally at emerging markets, there are companies that are providing financing for key solutions, even for folks who are unbanked and underbanked. We recently made an investment in M-Copa, which has been a pioneer in providing off-grid solar to folks in sub-Saharan Africa with microloans that they can pay back actually using a cell phone. And because of that, they've done more than 1 million off-grid solar systems for folks who don't have access to reliable electricity. And now they've expanded into other consumer appliances and even into smartphones themselves. So really important to think about how we can lower the first cost of sustainable solutions. The next thing I do want to mention is the role of special purpose acquisition companies, or SPACs. We've had almost 50 companies that could be described as ESG focused SPACs de-SPAC over the last year plus in 2021 and 2022. That's a remarkable number relative to the number of public companies that were clean energy and ESG focused prior to that. It's about more than 25% of all overall. And we believe there's an important role for the right companies to undertake the SPAC process. They get accelerated access to capital, which is critical to compete with incumbents in these areas. And frankly, investors also benefit as well. It democratizes access to these companies for folks who are mission aligned and want to put capital into, particularly on a long-term basis. And obviously, we've seen the performance of the standout companies like Tesla and Sunrun and others, be great returns for folks. And you get the benefits of greater transparency and greater accountability that comes with being a public company. And, people talk about, well, companies that might have de-SPAC'd and been disappointments, but frankly, the information that came out that led to some of those companies having challenges might never have been there if they weren't public businesses. So there's definitely a role for the SPAC market as well in accelerating sustainable technology innovation. Finally, just a couple notes about the other two factors I mentioned, public policy and consumer demand. Obviously, policy is critically important, but it was fascinating to us to see during the Glasgow COP last fall, coming out of that, everybody recognizing that the really leading players in driving change are the investors and corporate leaders, more so than governments. And governments, frankly, need to catch up, and they can do so not only through regulation, as we've seen in things like the infrastructure bill, the provision of capital, and the provisions in the Build Back Better bill, but the government has a role to play as a catalyst. And we're really fans of those who are trying to use the government's procurement power, its loan power through things like the Loan Program Office, and even the rule that was announced, or the proposed rule by the SEC last week on climate disclosure and reporting. Really important role to level the playing field, provide investors and consumers with consistent information about the climate risks that companies face today. Would we like to also see more consistent market signals like a carbon tax? We would. But in the meantime, government has an important role to play in fostering the kind of deployment of capital and technology innovation that I mentioned. And then the last area is really, frankly, up to us. It's consumer behavior, it's choice and demand on the part of customers, whether they're business to business or business to consumer. I mentioned the Tesla example, not only a great example of financial outperformance, but a perfect example of where Elon Musk said, look, my product needs to be not just cleaner and greener, it needs to be a better solution. And frankly, I think that's got to be the mantra for everyone. Whether it's better in performance or convenience or style or whatever it might be. We just invested in a company called Arcadia Power, which is a leading provider of customers to community solar developers. And the really attractive thing there is that Arcadia will go to customers and say, we can outright save you money on your bill by signing you up for community solar. There are other companies as well that are, showing us the power of the convenience. Look at Getaround, which is another company in our portfolio, or Turo, the same market, right? Peer-to-peer car rental and car share, just like Airbnb. You can put your car on a platform to be rented, and that provides convenience to those who are using it, particularly groups like millennials today who don't want to own a car. They can get access to one just using their smartphone. So in all four of these areas, we see opportunities to scale up innovation for clean energy, to make it go faster, and to achieve the outcomes that we're all looking for. And I'd be happy to take any questions and discuss further.
Thanks, Andrew. And the first question, actually, I'm gonna turn over to you because I thought it was pretty interesting. If you want to talk a little bit more about the SPAC market and your approach on, or your consideration that it's more democratizing, because I've heard, some people criticize or whatever, and having been around the space with myself a long time, as you said, there's a lot more capital available now, different types of capital, which is important. And I heard an interesting take from another investor who's like, I'm long on this SPAC because you have to be, because basically it's, as you said, it's this transparency. It's basically a last stage of financing that would have been private. Only that's why it's languishing at $10. He's like, I don't care. It basically did this round publicly. 18 months earlier. Can you speak to that a little bit more and how you see that playing from a positive angle on the democratization side?
Well, I think you put your finger on it. Most folks can't get access to those late stage private rounds. And actually what we saw over the last 3 to 5 years was public markets investors, some of the biggest, the T. Rowe's and the Vanguards and the Fidelities, trying to get into late stage private rounds. Now, essentially that process, again, can be made available to any investor who wants to participate. I think that's a good thing. And frankly, what we're seeing in the SPAC market is a bit of a shift away from short-term investors who are just looking for a pop in the stock to those who really start to see this as the entry point. Okay, I can buy in today. I mean, imagine if you'd been able to participate in Tesla's last private round before it went public. Tesla's gone up, I think it's 200-fold since it went public, something like that. And so I do think it's a positive factor. But as with anything, Rob, investors have to be smart. They have to look at all the factors of the business. Is this going to be a good company long-term? And as with any innovation in the financial sector, there's a lot of things coming in that probably aren't going to do well. And so you need to have the same screen of diligence and good judgment that you'd have with any evaluation of an investment.
Well said. Linda Silverman's got a question on, impact angel investors in climate tech and how, your firm is kind of working at, I think you said, make big bets and doing good things. You're at the later stage. Can you tell how that, with all these new influxes of capital, because I think, like you said, across the board, VC, any stage, there's more money here. How do these work together in the ecosystem from your perspective for some of the later stage investments that you made, or if you made some earlier bets than you might normally?
Yeah, look, we need capital at every stage, right? And we need capital innovation as well. So that's why I do think, folks like Generate, who are working with developers and technology providers of every stripe to make the cost of those solutions workable for end customers is really important. And by the way, some of their end customers have very low cost of capital too, like Walmart. They do a lot of fuel cell forklifts for Walmart's distribution centers. You'd say, well, why can't Walmart just do it outright? Well, there's always pressure on folks who are providing capital in large enterprises. So we need innovation at every stage. Look, we are excited about the amount of capital that's flowing into the sector today. I think the one thing, though, that we'll have to be cognizant of is to make sure valuations are not overinflated, because there has to be room for these companies to grow and investors to do well with them. So that's going to be an important thing to see going forward.
Well, your bridge background and analogy, I know our friend at the DOE, Jigar Shah, likes to use that quite a bit in his presentations. And just to touch on your government question, could you touch a little bit more on the procurement side and some of the other areas where you think, because like you said, the SEC rule is great. There might be some legislative roadblocks, but there's other ways to make an impact. Could you touch a little bit on that and what you've seen, even in your portfolio companies or elsewhere?
Yeah, Rob, it's a great point. And Jigar's, a longtime friend, and we actually had him speak last fall. He's a big believer in the notion that government needs to partner with the private sector to figure out ways to stimulate demand from the public sector. And also the Loan Program Office's whole objective is to provide, that bridge to bankability so that more private sector debt and equity comes into the market. So it's not about government kind of as government shouldn't be picking winners and losers. Government should be providing a level playing field so that all sorts of different technologies can succeed. But just to go back to the point about procurement, it's not a new issue. I actually started my career in this space in the early 2000s, working with a woman who had been the first kind of green procurement czar in the federal government, working for Bill Clinton and Al Gore. And they did a number of things to stimulate demand. And one of the simplest ones was, in the office product space, they said the government is only going to buy paper with 30% post-consumer recycled content. Well, overnight, that changed the entire industry. Every maker of paper said, holy moly, we better figure out how to make our paper with 30% recycled content. So the biggest players overnight started doing that. Why? Because the federal government buys something like 10% of all paper in the US. That should be the case in every area. Vehicles should all be electric. Biden is pushing in that direction, but they should be moving more quickly. The same is true when it comes to green buildings. The same is true when it comes to, obviously, the procurement of clean energy. So government has an important role to play, not only as a regulator, but as a market actor and a catalyst of change.
Andrew, thank you so much for your time. Great, as always, to hear you present.